and it will be up on either our YouTube page and probably our website as well. So if you want to go back and go through it again, and kind of hear our thoughts, take notes, whatever, feel free to do that, and we'll share more information about that. But with that, we'll get started.
All right. This is our semi-annual State of the Market Outlook for 2021. We'll do this again at the end of June, just to see how close some of our guesses have been. Tonight, what we want to do is recap 2020 and kind of give the most educated guess we can for 2021. And it truly is a guess. So we just bear with us, and hopefully we'll make the right decisions as we go forward. I'll look at 2020, the recap in 2020. We obviously had a recession, or mild recession, that was caused by a pandemic. Contrary to what you would think wouldn't have happened, we had record stock prices, government stimuluses. We did have some market winners and losers.
And I would say that the government stimulus probably had a pretty good amount to do with what the kind of growth we saw with the market. And we'll kind of go into that more and more. And along with the 2020 recap, we'll kind of go through the winners and losers, which areas of the market did well, which ones did not so well. And then as far as 2021, looking forward, addressing the new administration, now that, they've had a couple weeks in and are rolling out some changes and orders and things, a couple of investor themes for the year. And then y'all have all probably heard us talk about market timing. And so we're going to talk about, just again, why that's a bad idea, and a couple alternatives to that are better suited for investing. So that's kind of our agenda for tonight. So I guess we'll start off with the recap for 2020. My good place to start at.
All right. You really can't talk about 2020 without talking about the pandemic. The pandemic knocked the U.S. GDP growth back by 5 years. If you look at the chart there, you'll notice that we went from a little over 19 down to 17. We literally sunk from 2020 to 2015 in GDP. Now, by the end of the year, several segments had bounced back, mostly tech, and we're going to talk about that some too. And you're going to realize, so I was surprised that the impact of the tech is not as good as we like to think it is. Now, by early 2021, by now, we had bounced back to about the 2019 levels. But even if we get the vaccine rolled out, even if everything starts clicking, we're going to feel the pandemic for several years. There's no doubt about it.
Yeah, this is not something that is a quick fix. But with all of that said, you can see that, beginning in really
April,
March into April was when the big drop of the S&P 500 happened. And then shortly after that, less than 30 days later, we're back on the upswing. So with all the pandemic, the economic troubles that came with it, why is it that the stocks came back?
Well, y'all have heard us, have heard on the radio show anyway, have heard us comment that during the Obama administration, the market was significantly propped up by federal money. This is truly what happened last year. In 2020, the Federal Reserve balance sheet went past $7 trillion. Now, to break that down to English, what drove the markets back up is the Fed dumped an unprecedented amount of money back into buying bonds and stocks. They basically just churned cash out. And that made the market go up, gave investors a sense of encouragement. It is anticipated that our Federal Reserve balance sheet will exceed $10 trillion before this pandemic is over with. And prior to the pandemic, that even $7 trillion was an unreal number. Mm-hmm. But it doesn't necessarily denote a healthy economy as much as it denotes a very proactive federal stance.
Which is, there's some argument for that, but again, just something to be aware of. So, along with the stimulus we're talking about here, that costs money. And so you can see there what the budget deficit was for 2020. In 2020 alone, it was $3 trillion. But along with that deficit came the single largest transfer of wealth from the public to the private sector in history. And that's really why you started seeing these stock prices just shoot through the roof, because now you've got money coming from the public sector, the government, into investors' hands. And, instead of leaving that in cash, because people have plenty of cash, they want to do something with it. They want to get some return on that. And so where do they take it? Back into the market. And so that's why, even with the economy struggling because of the pandemic, the market bounced back very quickly. I mean, we're talking within 60 to 90 days, it was back up to numbers prior to the pandemic, and then some.
And then some, yeah. So if you look at 2020, you can see a big dip by the pandemic. And then after that, the growth is pretty much federal government stimulus. And again, the government is supposed to do things like this, but it doesn't necessarily bode for a strong economy. Now, based on the early numbers of 2021, it looks like most people, most entities are anticipating further stimulus because I personally thought that with the new administration in place and with the Democrat-controlled House and Senate, that we would see some fallback in the market. And we've seen some, but nothing like I thought we would. I thought we would be substantially depressed by now.
Yeah, we were fully, and we've talked to some of you that are here, and the two of us were pretty pessimistic, I guess, after the results of the election. We fully expected a pretty heavy decline, even in 2 weeks after the inauguration and the election results and everything, and we just haven't seen that yet. But we'll talk more about I guess our predictions of that later. Stick on 2020 for right now. So again, we're going to talk about we've talked about why the stocks did so well, and now going into a little more detail about that, you can see here that at this lovely chart, that the growth stocks outperformed value stocks again in 2020,
which has been the case for most of the decade. This is not unusual.
Mm-hmm.
They have pretty much outperformed value stocks in over the last 10 years. But what is interesting to me, and what's frightening too, is the tech stocks really blew it out of the water this year, or 2020, because between social distances, quarantine, work from home, they got a boost. The energy sector performed the worst, and I believe,
surprisingly, that kind of came as a little bit of a surprise.
But I think that energy sector performed the worst because all of a sudden the United States, prior to Mr. Biden coming into office, the United States was energy independent for the first time. I do think one of the things we're going to see in the very near future is you're going to see gas go back up to $3 and $4 a gallon. But,
I mean, we're already seeing it. It's gone from less than $2 to close to $2.30 a gallon. So we're already starting to see some effects of his plans for the country.
Of the pipeline of moving to green energy.
Yep.
This is probably one of the most amazing statistics to me. If you look at how the S&P came roaring back, 5 companies, Apple, Microsoft, Amazon, Alphabet, which used to be Google, and Facebook, made up 1/4 of the S&P 500 index. 8% of the companies made up the other 50%. So when you look at the S&P 500 index, really only 40 companies contributed to that massive return, with the top 5 being Apple, Microsoft, Amazon, Alphabet, and Facebook.
Yeah, I mean, you can see there that of the 500 companies represented, the other 460 combined achieved the same growth as the rest of them, which is just incredible
and
to say the
scary.
least. Yeah, and scary.
So if you look at the total S&P return in 2020, it was 18.4%. But again, those top 5, Apple, Microsoft, Amazon, Alphabet, and Facebook, made 14.35%. And the other 495 companies contributed 4%. So it's a little bit scary to me. And, y'all know I'm a conservative right-wing nutcase. It's a little bit scary to me that the companies that we're beginning to have so much issue with censorship and whatnot, are the ones that are pretty much carrying the United States stock market right now. I mean, I won't say they're bulletproof, but man, they're mighty close to it.
Yeah, and if they go down, we're in trouble. I mean, that's sort of a scary thought to think that of 500 companies, five of them are carrying the entire index. It's almost like what's the point of having the other 295
495.
495. I'm sorry, 495
Math is not
companies.
strong.
Yeah.
But what's really frightening is if you think about it, all of these companies are intertwined. They're all tech companies: Apple, Microsoft, Amazon, Alphabet, Facebook. So if one of them got a hit, they'd all would more than likely would take a fairly big hit. I know you can say that Amazon is more of a retail company, and I suppose there's some truth to that, but nevertheless, it is tech. Bonds had an outstanding year. If you had told me bonds were going to have a banner year in 2020, I wouldn't have believed it.
Yeah.
Because interest rates dropped up like rocks, but everybody was afraid. And so they moved into bonds, and the long-term treasury bonds actually gained almost as much as the S&P 500. I mean,
that hadn't happened in
it's astonishing.
a while. Yeah, that's just unusual.
But part of that is because, next slide, even though our rates went down, we are outstanding. Our bond rates are outstanding compared to other countries. Mm-hmm. If you look at the United States bond, the yellow is 2019, black is 2020. And if you look at us, we're ahead of Canada, Italy, UK, Japan, France, Switzerland. So I think a lot of this banner bond market was caused by foreign entities coming in and buying our government securities. Mm-hmm. Because even though to us it was not a very good yield, to them it was substantially better than what their home countries had.
If you look at Switzerland compared to a negative return, less than 1% return of the U.S. is pretty good.
Yeah. The best market segment in 2020, and I was astonished by this too, I was surprised by a lot of this, are convertible bonds. And convertible bonds is something you don't see a lot of. They're basically a bonds that you're buying a bond for a company. And as most of you probably know, a bond is essentially a loan to a corporation or to the government. And a convertible bond has the right sometime during the life of the bond to convert it over to that company's stocks. So if you're buying a bond for XYZ and down the road, you can convert that to stock. So they had a banner year. They rose more than 50%. One of the really bad sectors of the market was REITs, Real Estate Investment Trust. And I guess if you think about it, that makes sense because during the pandemic, people stayed home, office buildings, retail stores, everything plummeted, occupancy plummeted. So you can, even now you ride through parking lots and they're
empty office buildings.
They're greatly empty. Yeah.
Yeah. And I guess the convertible bonds, now that I'm thinking about it, I guess that makes sense because you're kind of getting the best of both worlds. You get the guaranteed return of the bond, but if if it turns out that the market's kind of back on the upswing, you can convert that into stock. So I guess now that I think about it, I guess that kind of makes sense. People are sort of hedging their bets against the market while giving themselves the ability to get back in if they feel that it's time to do so.
Now, an obvious question would be, hey guys, why don't you have some convertible bonds? Good question. Biggest reason is when you see these bond returns like this, you're looking at big, big, big numbers. I mean, where entities are buying $600 or $700 million worth at a time, or in the case of the federal government, sometimes billions. Mm-hmm. Yeah. So if you have convertible bonds in your portfolio, and all of you do have some in your portfolio, by the way, they're there. They're not as big a player as we would like them to be, but because it takes big bucks to make those work. Mm-hmm. All right, that was kind of 2020. Let's kind of talk about 2021.
Yeah, let's look forward a little bit. There's a lot of uncertainty right now with the new administration and things. So we're going to kind of run through that. So can't talk about 2021 without talking about the new administration. So I know we've had this question a ton. I'm sure all of y'all have thought about this. What does a Biden administration and a Democratic-controlled Congress mean for maybe not the capital markets, but for my investments, for your investments?
Wealth inequality.
Yes.
If you're already hearing that we got to take money from the rich and give to the poor.
Yep.
You're already hearing the higher taxes for top earners and corporations, although the latest tax indication we're starting to see is a tax on the middle class, not on the 400,000 up. And let me talk about that just for a second too. remember that America has a progressive tax code. So when you're talking about taxing incomes of 400,000 and up, if let's say I made $1 million a year, which is not correct, that additional tax would only be on the income I made above $400,000, not the entire amount. Everybody's in the same tax bracket, and they phase out. So, and I'm gonna get this wrong, but like the first 7,500 is tax free, and then from 7,500 to
like 19,000
is 6%, and so when they say we're only going to tax the top people that make more than 400, what they're really saying is we're only going to tax income above 400,000. Now, here's where this gets to be dicey. People or entities that are making that 400,000 are generally people that either have their own businesses or own big real estate, that kind of thing. And one thing that I don't know, I guess it's just a party concept, but they're going to pass that down. It is, and you can't really say that we're going to tax the higher income earners and we're not going to touch the people underneath that, because it's going to get passed down.
Yeah, the people that own these that make that kind of money are not going to eat that. They're not that nice. They're not just going to eat that cost because they're just feeling generous. They're going to pass that down in the form of higher rent, higher prices for products. I mean, everybody's, so at the end of the day, the middle and the lower class are going to be the ones to feel it. I mean, we're going to be the ones affected by that.
I'm actually more afraid of the next one: less fossil fuels, more renewable energy. One of President Biden is, and it hurts me to say that, President Biden. But anyway, President Biden is working on a climate plan, and it is estimated it's going to cost $1 trillion. That's trillion with a TR, not a D. And it is also estimated that it is going to closely emulate the green market plan, which AOC has been pushing, which is utterly insane. So that, and the shutting down the pipeline is the first indication of that. That's a big deal. That's
scary.
Well, it makes a lot of entities mad. Mexico, Canada, and Montana, for one thing, not Mexico. You've actually laid off 72,000 people with the stroke of your pen. And it's frightening to me that President Biden has done more executive orders in his first 2 weeks in office than the other previous 10 presidents combined. I mean, executive order is nothing more than this is what I want done and we're going to do it. It basically bypasses Congress. Mm-hmm. And there's more and more of those coming out. I'm okay with regulation of financial services. I think that's fine. Mm-hmm. I think we need to be some regulation. But remember this, that if you force big entities, and I'm not talking about little shrimp like Georgia now, if you force big entities like Bank of America or Edward Jones or Merrill Lynch, if you force them into additional regulation and they have to hire people to manage that regulation, who's going to pay for it?
That means more people means more fees.
Yeah.
And again, the people that have accounts, your 401ks, things like that. That's what gets hurt by this. Not the big banks and not the financial companies, because they are not going to eat that.
They're just going to hire attorneys and hire regulators to take care of it. And just give you an idea of how tangled this already is. Because we're an independent entity, we've in the Journeys Group, we get audited by the state of North Carolina every year. That's just part of the deal. We were audited in December. When December?
November.
All right.
Yeah.
And we've been told it will probably not be till March or April.
If that early,
until we get the results of that audit. Now, if it takes them that long to do our audit, and we're a very small entity and we're a clean entity, nothing wrong with what we do. My goodness, what must it take to be how long must it take to be to do a big company? I mean,
and you think about this, how much in the time that it takes for the audit to come back, how much potential damage could that big financial company be doing, knowing or unknowing, in the time that it takes for this stuff to come back? So again, certainly not a bad change, but the results from it could be
Expensive.
expensive.
Yeah. Push for infrastructure spending. That's not that unusual. Every president since the dawn of time has said we need more roads and that kind of thing.
Mm-hmm.
Janet Yellen being the Secretary of the Treasury, Jerome Powell staying as Federal Reserve Chair, that's probably pretty good because the financial service entity or the financial industry knows them, is pretty comfortable with them, doesn't necessarily agree with them, but they kind of know how they think and kind of know how they mean, how they work. All right, what are some considerations for investors?
If you've met with us recently, we've talked a lot about this. You hear that, we have a Democratic-controlled Congress, and technically that's true. But they do not have this massive majority. The majority in the House, I think, is 8 seats? But I mean, it's very, very narrow. And again, in the Senate, the only reason they have a majority is if every senator shows up and every senator votes. So all of this progressive stuff that they're threatening to shove through, probably not going to happen because it's
unless there are 2 tools left. I'm sorry, but
no, that's okay.
2 tools. One is the
executive
action that Biden's doing left and right. The other is that little word called budget reconciliation. Budget reconciliation is how the Democrats push through Obamacare. Essentially, you can do budget reconciliation once a year. You have to have a budget in place to do it, but it basically makes a simple majority is all you need to do to pass something significant about, from a budget or tax standpoint. Second thing is, and we have said ad nauseum that no one can tell you what a good stock or a bad stock is going to be.
And I think this graph right here is living proof of why these people that say, sign up for my email list and I'll give you my top stock picks. Yeah. I think this right here tells you exactly why we warn against that.
These were the ones that were supposed to do great under a Trump administration, and they were among the worst performers. So the lesson here is nobody knows what's going to happen. Mm-hmm. So if you're an individual stock picker or sector picker, it's either a home run or a strikeout. And there's more strikeouts than there is home runs, which is why we're so strongly push diversity and diversification. Because if you live by the sword, you die by the sword. Regardless of anything entered, it's foolish to think that the pandemic and the government stimulus are not the 2 biggest players in 2021. Until the public feels like that the federal government has a handle on the pandemic, then we're going to continue to have a very, very shaky economy. So right now, what is helping the markets, again, is the government stimulus, and probably will continue to do so until we get past this pandemic. But it's important for us to understand, even if we have everybody vaccinated by May, just for sake of argument, then the effects of the pandemic are going to be here for 2 or 3 or 4 years. This is not a quick fix. This is going to go away by any stretch of the imagination.
Yeah, so we're going to talk about a couple of themes for 2021. Recession. It's a scary word. Nobody likes to talk about it. The projections right now are that the U.S. economy will likely grow a little bit in 2021. Nothing dramatic. Nothing like we saw after the dip in 2020. And again, that growth is entirely contingent on containment of the pandemic. If we can't get it under control, if the vaccinations don't happen quickly enough, if the federal government can't get the public idea of the pandemic in a positive manner, that growth is not going to happen. That's the one thing standing in the way. And again, this recovery is glass. It would not take much to shatter the recovery. And it is very likely we will see another recession. And again, that may be due to legislation, but primarily, again, due to that pandemic. If we don't get the public idea of, if people aren't comfortable with COVID, if they don't feel like it's under control, growth isn't going to happen, and we're going to have a dip again. We will see a double dip recession.
it's important to realize, and I'm talking directly to the clients of the Journeys Group. If we have a recession, if we have the market drops precipitously, your accounts will go down, yes. But because we have designed the portfolios that each of you are in, or the financial plans that each of you are in, to reflect your age, if your accounts go down, it is not going to affect your retirement, because we have designed your situation, if you're close to retirement age, to protect you from a bad market. So it doesn't mean you should get out of the market. We're going to talk about that in just a minute. And it doesn't mean that if the market goes down, we're in trouble, because y'all aren't. You might be aggravated, highly annoyed, but this is not the type of scenario where anybody's like, well, I got to go back to work. I've lost all my investments. That's not it at all.
When we put these plans together, we factor in 2020 years. You know, obviously 2020 was an aberration, but we factor those kind of years in and go ahead and take that into account, so that when they do happen, yeah, again, you're irritated, but it does not affect you negatively in terms of being able to retire.
The second big investor theme is this: stocks are expensive. They're as expensive as they've been in the last 2 decades. And again, this kind of seems counterintuitive when you think about how fragile the economy is. But it is our feeling that because of stimulus, low rates, the Federal Reserve Board actually announced either yesterday or the day before yesterday they were going to leave rates where they're at, that they could very well continue their upward climb, albeit not as dramatic. And so, yeah, you kind of think, well, good, I'll just buy some more stock. But if you're buying at these prices, there is some risk, because it doesn't take much to lose money. Again, for the vast majority of you, you're already in this market. You're not buying at a high price stock. You're already there. And so you've actually taken advantage of the growth that we've had. We had a client yesterday. We handled a charitable portfolio for somebody, and they've got some cash and they wanted to make some purchases. And I said, well, just wait about a week or so, because right now it's high. And that's not really, that's not market timing in this case, because they're going to, once we make the purchase, they'll stay in for decades. But yeah, stocks are expensive right now, and I don't think the average investor realizes that.
Or most people see that stocks are high and they think, well, shoot, I need to get in on that, not realizing that by the time they see it at this all-time high, they've already missed out on that growth. And again, it would not, because the prices are so high, it would not take much decline to lose money. And you know, we've talked about this before, that you don't buy at a high and sell when it's low. I mean, but that's what most people think. Most people think, ooh, the stocks are high, I need to get in. But again, you've already missed the mark there. And again, we'll kind of talk about this right now.
Let's talk about market timing, because we have had many people, some of you have called and said, should I get out of the market, move to cash? And let's look at what market timing does. In 2020, if you held straight S&P 500 stocks, you would have had a return of 18.4%.
That's pretty good, considering a pandemic year.
Now, suppose you did that, but in April the 1st, after the market dropped 20%, you got out. And then very quickly after that, you bought back because you saw the market was going up. Instead of an 18.4%, your return would have been 6.6%.
Yeah, you're looking at a 66% loss of return by, 30 days, by being out for just 30 days.
Yeah. But this is market timing. You missed the decline, but you also missed the recovery. Because remember that when the market's recovering and you jump back in it, you've missed it already. And that's why I tell people, do not try to time the market. Don't come in and out. Remember, the old rule is every time you move money, there's a fee involved. Not with us, but with anybody, with entities on Wall Street. Yeah. So you got to realize that. So do not jump in and out. One of the reasons why we use the type of portfolios that we do is so that you don't have to jump in and out. As George said, we don't anticipate a pandemic, but we anticipate bad years like this. The returns we've had over the last 4 months have been 20%. I'm pretty happy with that. But you just got to ride the course. Remember that the market, there has never, never, never been a time, a 10-year run where the market wasn't positive. Never. If you count 2008 recession, you count the Great Depression, there's never been a time where the market didn't outperform everything else over a 10-year time period.
And again, and over your lifetime, which is when we invest, we're investing for a lifetime. We're not investing for a week, a month, even a year. We're investing for again, 10 plus years. And so when you're in with us, you're in for the long haul. And again, over your lifetime, the stock market will average between
prior to 2008, it was 11%.
Now we're looking at between 6 and 8%.
Although this year's the last 6 months going to really pop it up some.
Mm-hmm.
But that's why most of you that are close to retirement or are retired, that's why most of you, we have your exposure at no more than 50% of the market. Not because we don't believe in the market, but because we don't know how much time we have left. I don't mean your life expectancy. But when you're living off of your investments, you're making a monthly withdrawal off your investments. If you have to take a monthly withdrawal and you have a 100% dip like we saw in April of last year, you can't recover from that. Mm-hmm. So by minimizing your exposure to the market, 50-50, 60-40, that kind of thing, we protect you from a dip like April, but you still enjoy the climb like we say.
Mm-hmm. Exactly. So again, we've talked about investing for the long term, and why should you? This graph is very telling. If you look at each bar, the percentage at the end is the percentage of time that money was lost at any given time between 1970 and 2020. So
over the last 50 years.
Over the last 50 years. So if you were investing in the S&P 500 for 1 month, roughly 40% of the time you lost money. If you go 3 months, now you're at 33%.
And so if you
1 year, 25%. So there's a huge jump as you're going from, less than a year, just even a year.
Well, and that's why we tell people don't invest money in the market for short term. Short term being 2 or 3 years. We have people that will call and say, we'd like, I've got a daughter or got a child that's 12 years old. We want to start a investment account, send her to college. What should we do? Put it in the bank. Mm-hmm. Because I can't guarantee a positive return in 6 years. Mm-hmm. And so when we invest money for our clients, for you, we assume it's going to be there forever. Doesn't mean you can't take it out, move in and out, take money, use it as you need to, but it means that we're not going to run screaming for the hills if we have a bad market. Like I said, over the past 50 years, never been a period of time over 20 years in this scenario mm-hmm. where there was money that was lost. Yeah. Another alternative to market timing is diversification, and this is what we do. Historically, when high quality bonds have performed well, stocks have performed badly, and we saw this in action the first quarter of 2020. Mm-hmm. It's not quite as strong an indicator as it used to be. Some of with the federal government screwing around with the market has thrown some of that off, but every portfolio should have some bonds in it. And if you're a 50-50 holder, like a lot of you are, that's 50% stock, 50% cash and bonds. Now, remember, your portfolio with us is never more than about 2-3% cash. So if you're 50-50, that means about 47% is in bonds. Mm-hmm. And in theory, if the Feds don't screw with it, as stocks go down, bonds go up. So that diversification is what protects you. If you look at the graph on the far right, you'll see that bond returns are positive when stocks are negative.
Yeah, we're looking for that negative correlation so that if stocks are doing, if investment A is doing really well, investment B may not be doing so well, but they offset each other. And that's really the point of all this diversification is you want to make it so that if one is down, something else is offsetting it.
So in some ways, 2020 provided a good fire drill. You had a disaster, and then you had a growth. So if markets plummet again, is your portfolio going to be ready? And if you're a client of ours, the answer is yes. That's why we use annuities for some of you, so that if a market tanks, and we want to stop taking money, or a portfolio rather tanks, we want to stop taking money out, we can live off the annuity. We try to design your plan to anticipate, yeah, there's going to be some April 2020s. And so that's why, we've had some 18-20% returns. But when we did the math to figure out what we were going to do for a client, we used 6% because it gives us a huge push factor. So yeah, if you're working with the Journeys Group, you're going to be ready, not because we're geniuses, but because
we're very conservative with our estimates, and
we know how the game's played, quite frankly.
We plan for this.
All right, so let's summarize real quick. Pandemic threw the world into a recession. Economic recovery is there, but it's still pretty fragile.
It's a little iffy.
Yeah. But stocks are at an all-time high. Largely driven by government stimulus, the magnitude of which we have never seen.
Yes. New legislation on the horizon, but again, the pandemic and any further government stimulus will have a much larger impact. You may be tempted to time the markets with how much up and down there is. A lot of new risks that we've talked about, don't do it. Instead, take a look at 2020 and learn from that. Again, putting it in there for the long run and diversification, I'm not going to say it totally eliminates these risks, but it really, really
that would be why we say greatly mitigate.
Yes.
Mitigate means it lessens it.
See, I didn't know how to pronounce it, and I didn't want to look dumb in front of the people.
We practiced this before we came on the air with y'all.
Yeah, and I get nervous, and
apparently a polysyllabic word is too much for me.
Don't curse at me like that.
Hey, really. So that's what we have, and so if you guys got some questions for us, be glad to. We'll read them out and tell you what we think, and or if you just have some comments, by all means, fire away. We'd be glad to hear anything y'all have to say. And if you don't have anything to say, we'll call it a night. But we'll give you a minute to see if anybody wants to say anything. Either you're extremely hungry or
or they're asleep.
That's it, probably asleep.
Well, I did have a few questions sent to my email prior to this. We've been getting a lot, so we'll run through those while people may be thinking of questions, typing them out. We've had a lot of questions about cryptocurrency and Bitcoin. Is it a good hedge against inflation? Is it going to take over the dollar? No, not yet anyway. Bitcoin, cryptocurrency, I wouldn't touch it, and for a number of reasons. Number one, it's still brand new. There's a lot of unknowns. There's nothing to value it against. The dollar is valued against, what is it? The gold in Fort Knox, correct? Bitcoin has nothing like that, and so there's no reason why it's worth what it is. And number two, with Bitcoin, there has to be a buyer for Bitcoin. And there just isn't really a market for it. So I wouldn't touch it. I had another question about preparing for inflation. Again, clients of ours, we have factored inflation in. So your portfolios reflect that.
We also hear a lot of people want to know, is this the time to buy precious metals? And I am not a fan of precious metals for the simple reason that you have to have a guaranteed buyer. And one of the things that we talked about is, if I've got an ounce of gold and the market tanks, everything goes to heck, and I walk into Food Line with my ounce of gold, are they going to have change? And the answer to that is no, they're not.
You're going to buy $1,000 worth of milk.
Yeah. Got a couple of questions. If a person had $30,000 to $40,000 to invest right now, where would you recommend? And the answer, I'm going to answer that with a question. And that is, if you, it depends upon how quick you want that money back.
And what you want the money to do.
If you are going to put this money up for 7 or 8 years, 9, 10 years, I would, depending upon your age and whatnot, we would use the market. If you want this money back in 2 years or 3 years and you want something guaranteed, then there are some products out there that offer a very small 2.5%, 3% guaranteed return. So it's highly it depends upon how quick you want the money back, or what kind of access you want to it.
Mhm. Yeah, got another question about renovations and costs of everything going up. Um, Costs of materials right now are sky high, aren't they? I mean, you're looking at getting
Yeah,
some
we're
building
fixing
some
to.
stuff, and
We just bought some 2 lots to build new offices for us, and we're not going to build any offices anytime soon because the building prices are insane right
mhm.
now. And so I might do renovations. Again, depends on how drastic the renovations are. But with the way the interest rates are right now, if I did renovations, I would probably do a home equity line of credit, because you can probably get one of those for 2.5%, and
Heck of
you're
a lot
making,
cheaper.
yeah, you're making 8 or 9% on your investment.
Mhm.
Now, if I think renovations is okay, I wouldn't build a house right now.
Something like a smaller project, redoing a bathroom, something like that, probably okay. But anything big, I would hold off if you can. Um, Got a administrative question. Yes, the website will be on, or the it's not the website. This is being recorded, and it will be on the website and on YouTube. So yes, if you want to go back and watch this later, and kind of rewind, fast forward, it will be available to do that. Got another question about 401ks. Staying diverse still the recommendation? Absolutely, always.
Yeah, you always stay diverse. Always. There's no time that you don't. The only time not to stay diverse is if you got some insider trading. That's about it. I mean,
Yeah.
but yeah, because right now S&P is killing it.
Nailed it. Yep.
3 months from now, it may not be S&P, it may be foreign stocks.
Mhm.
And by the time, if you are all in S&P and you see it going down, foreign stocks going up, well, I'm going to jump out of S&P, I'm going to go to foreign stocks.
You
You
missed
saw
it.
the market timing
Mhm.
scenario. So yeah, no matter what your age, no matter what investment vehicle, no matter the length of time that you have, diversification is always the key to it.
And always being in the market too. To us, it doesn't matter how old you are. It's always a good idea to be in the market. The only thing that changes is how exposed in the market you are.
One other question we had is, should you pay off your mortgage right now? Understand that a mortgage is not the tax break that people think it is. So
Very
paying
minimal.
off your mortgage really is determined by what your interest rate is.
It's a definite maybe if you should pay it off.
I mean, if you're paying 2.5% on fixed rates mortgages, and we've got some people that are doing that, shoot, no, I wouldn't pay that thing off. If your rate is 5 or 6%, I probably would pay it off.
Mm-hmm.
So again, I hate to beat a drum here, but this is why we do financial planning, not sell stocks.
Mm-hmm.
Because whether or not you need to buy or pay off a mortgage is directly dependent upon your personal situation, your individual situation. There are some people that makes perfect sense to pay off a mortgage. There are others it's crazy to pay off a mortgage, and it just depends upon those circumstances.
Mm-hmm.
I believe that's it. We have any other questions real quick? If not, we'll let y'all go get supper.
Yeah, we'll hang out just one more minute, see if anybody's got any further questions.
But we certainly appreciate y'all's time tonight. And I think our featured event next month, and you'll get an email about it, I think we're doing a coffee tasting next month.
Or it's like a coffee pickup with
well,
COVID still
going a coffee tasting.
Because it sounds fancy.
Yeah.
But yeah, keep an eye out for, we've got a lot more. We're going to start trying to do a lot more events. We will have more events like this about once a quarter on different topics, different fun stuff throughout the year. So keep an eye out for that. We'll be sending out more details.
April, we got a shred day. We're going to take the parking lot behind Aquaventure. We're going to have an industrial shredder there the weekend after income taxes. Mm-hmm. So you can come get your stuff shredded. And we're going to have food trucks there. And if you're a Journeys Group client, you'll have an allowance to go spend at the food truck. So you can bring your family, eat, shred your stuff, all on us. So
like I said, keep posted for that. I don't see any more questions, so I think we'll let these fine people get out of here and head on. Again, thank y'all so much for stopping by, for tuning in. If you do have questions that come up later, call us, email us. And other than that, y'all have a great evening.
Have a good evening. We all